on some of the value pricing fundamentals that you actually learn over time as you start unraveling all the different concepts of value pricing. These are the four things I've learned through my practice. Number one, giving a fixed price isn't always value price. So just because you give a fixed price doesn't necessarily mean you're value pricing. In many cases, I see accounting professionals put a public price on their website and even with options, but it's the public price that is for everyone. And by definition, if you're not attaching your services to what your customers value, or you're not pricing the customer, it's technically not value price. Now, there are some components of value price on fixed pricing and options, but you have to actually understand what the client values, what's important to them before you can give a price and truly call it value price. Now, menu pricing is also not necessarily value pricing. This is where all your potential services are broken down into little items, reconcile one bank account, reconcile two bank accounts, whatever happens to be, and you put a price tag on each one. Now, that's menu style. That works great in restaurants. And yes, the customer can pick more and pay more, but at the same time doesn't specifically speak to how much they value the end result of what you want. Value billing in arrears is also by definition not value pricing. Many folks take on an engagement, they have a high level of trust with their customers, they don't bill by the hour, and they say, oh, I'm value pricing. But if you don't give a price up front, if you don't actually exchange a price for a signed agreement, it doesn't have to be signed agreement, verbal agreement works well, but if you don't give a price up front in exchange for a scope or some sort of result or guaranteed result or understood result, then it wouldn't be value pricing. Now, I'm a culprit of that. I have many clients in which in the middle of tax season, things are moving really, really fast, and I don't have time to price every single thing. So we end up just doing the work and billing it afterwards. And that's wrong. That's not value pricing. So I understand that people do it. I just want to make sure that you don't confuse the two and think, okay, I did it, I value priced it. And no, by definition, if you're not given the price up front, if you're pricing in arrears, it wouldn't be value pricing. Now, the other thing that I understood over time is that true value pricing should always be good for your customers. So if you price something and the customers perceive value of that service, it's at the same of the price or possibly higher, then you're value pricing. That means the customer is getting the value for the price. That doesn't always translate to profits for the accountant. It is possible that you're dealing with a customer that doesn't understand the value. Maybe I blame it back to the accountant. You don't know how to communicate the value, or maybe you didn't understand what their true needs were. And true, there are some customers that are just not good customers. And what can you do? Bad customers, get rid of them and move on. But don't try to make every customer fit into your model. If the customer cannot value, or you cannot find ways to add value enough, so they pay for that, they pay for that price willingly and happily, then they're just not the right fit. So those are just quick things that I learned on that. And I wanted to give it up to Kirk so he can talk about his presentation on pricing options.
Hi, everyone. Thanks for watching this recording. The title of this session is Pricing Options for Accounting Services. And I guess there's two ways you could take that title. You could say, okay, we're pricing options, as in setting a price for options, or the type of options we're creating are around price. And that's really what we're talking about here, is how do you offer the customer choices? And I want to walk through an example that'll help illustrate why choices are important for the customer. This is a subscription form that was used by Economist Magazine a few years ago. In fact, this is one of the examples that's used by Dan Ariely in his book, Predictably Irrational. It's a little hard to read, but the first option is for a print subscription for 1 year to The Economist for $59. I'm sorry, the first option is an online subscription for $59. The second option is a print subscription for 12 months for $125. And then the third option is for both the print and web subscription for $125. So we have the first option at $59, and then options 2 and 3 are at the same price. Now, you would think, looking at this, that they made a mistake. Why would you offer two options at the same price? And Dan Ariely, when he saw this, he had the very same question. So he actually called up Economist Magazine and said, hey, what's going on here? Well, he got passed around from one person to another, and basically determined they didn't realize they had done this. It was an accident. But Dan asked the question, well, how would customers make a selection when they have 3 options versus 2? He's a college professor. And so what he did is he gave that subscription form to 100 students with all 3 options. If you look in the middle column, you'll see that 16 students chose the online version and 84 students chose the print and web. Nobody chose print only because it was the same price. If you look at the right-hand column, there are 2 options. And this time, the online option was selected 68% of the time versus the print and web 32% of the time. The only difference between these two is simply the presence or lack of the middle option. What this illustrates is customers really don't know what the value of something is. And in order for them to be able to attribute value to something, they need to be able to make comparisons. And so when you offer the customer choices, when you offer them 3 prices, you're actually helping them decide what is valuable to them. And so you're actually making it easier for them to make a better buying decision when you offer them options. Not only did it help select options in this case, but it also contributed to higher revenue. If you look at the revenue for the subscription form with 3 options, you can see that it was almost $11,500 versus 2 options was roughly $8,000. So about a 33% difference. That's an illustration of not only how options help the customer make a decision, but how options are more profitable for the professional. Steve Major, who is an accounting professional from Australia, was a guest on my podcast, and he said something that I think is really key. Value pricing can change your business. Value pricing plus options can change your life. What Steve really is illustrating here is if you want to get the maximum benefit from value pricing, you need to do it with options, because without options, it doesn't have the same dramatic effect. I was working with one accounting professional named Chris Farman, who's from Florida, and he works with craft breweries. And one of the things I was able to help him do was increase the amount of revenue on a particular proposal, which normally would have been about $16,000. His customer actually wound up selecting $30,000. So he got $14,000 more dollars in revenue just by offering options. When you boil it down, options has an impact on the customer's mindset. When you offer them only one choice, take it or leave it, yes or no, the question they're trying to answer is, will I work with you? It's essentially an ultimatum. But when you offer them choices, that question changes to, how will I work with you? It's a subtle shift. The customer doesn't even realize it happens, but in their mind, they go from trying to decide, are they going to hire you, to how are they going to hire you? And obviously that shift has a positive impact. It should increase your closure rate. Now, when I talk about value pricing on my podcast, our slogan is discover value, create options, and start pricing. Discover value is the first pillar, and creating options is the second. Now, I've got a whole nother session that I do on having that conversation where you discover value, but I want to cover a few key points before I get into options. Again, it's a value conversation or a why conversation, and the root of it is from this diagram. We're all in the accounting profession, so we understand basic math, that the price the customer pays less your cost is your profit. But what we lose sight of is the customer's profit. Whatever the value created for the customer, when you subtract the price they pay, that's their value. And on this particular graph, that's represented by the gold bar. And you can see that on this graph, the customer's profit is twice your profit. And you at least want it to be a double, if not 3 or higher multiple. Now, there are 3 key questions that I think you can ask to help discover value from the customer's perspective. And I'm going to give these to you very briefly. The first one is, why now? There is a reason that the customer is seeking this particular solution right now. There's a reason that 6 months ago was not the right time, or waiting another 6 months is not the right time. Why are they doing this now? That's the first question you want to get an answer to. The second one is why this? Now, this gets into the idea that a lot of times when customers come to us, they have self-diagnosed what is going on. They've essentially written their own prescription as well. Now, if a doctor writes a prescription without first doing proper diagnosis, that's malpractice. And so what we have to do is help our customers, we have to help prevent our customers committing malpractice on their own behalf. And that's why this question is so important. You want to ask, why this? Why do they think this is the solution? Don't just accept their own diagnosis, but perform your own. And then the third question is, why me? You could think of this as a marketing question. The answers to this might be, well, you're the expert. I've read your blog. I've seen you speak. I've read your book. It could be, well, you're local to me, or another variety of reasons. It might be a referral, but understanding how they value you is also part of the equation. So that's a quick rundown on discovering value, but let's spend the rest of our time talking about the second pillar, which is creating options. I've already explained with the economist example why offering options is so important. It actually helps the customer make decisions, and it will typically increase your revenue. There is a magic power in 3. Think about Starbucks. When you go in, you can buy your coffee either tall, grande, or venti. If you go through a drive-through at a fast food place, a lot of times if you're going to order one of the value meals, they're going to ask you, do you want that small, medium, and large? Airlines do this. When you fly on international flights, you can buy a coach seat, a business class, or even a first class seat. So the power of 3 is used all over the place. And if you start paying attention, you'll notice it. There's a reason you want to stick with 3. 4 is too many, 2 is too few, 3 is just the right number. What I want to give you is 7 categories that you can think about as you're creating options for your customers. Each of these categories begins with a letter T, and so I call this the 7 T's. I'm going to walk you through each one, and then we're actually going to look at some pricing options that Hector created for one of his customers and kind of break those down in these categories. The first one is tailoring or customization. This is the one where in professional services, I think you have the most opportunity to do something unique for each customer. And that's really what this boils down to. You're looking for how can you customize the services that you're providing to your customer in ways that increase the perceived value to them and allow you to set a higher price as a result. Think about an athlete who needs to get a custom tailored suit. They can't go in the store and buy one. They've got to go to someone who makes custom suits. We're doing the very same thing, just with accounting services. Second T is talent. There are a couple of different ways that I think about this. Number one, if you have a firm with more than one person, it could be, well, who does the customer get to interact with? Is it the senior accountant or the junior accountant? Is it the bookkeeper with 10 years experience or the bookkeeping intern during the summer? That's one way to think about talent. Another way to think about talent is, what access does the customer have to that particular individual? Will you answer emails, and how quickly will you do it? Can they text you? Can they call you? Could you have a customer use your mobile phone to contact you on a weekend? I have a colleague down in Australia who's an attorney, and he was able to charge 5 figures strictly because a customer had his mobile phone and they had an agreement that if the customer called, he would answer anytime, 7 days a week, 24 hours a day. This particular customer had to acquire in a business. He didn't know exactly how many times he'd need to talk with his attorney. And so basically, he put the attorney on speed dial. The customer only used that option one time, but the advice he got was worth the price he paid. So that's kind of one way that talent can be used. Third C is technology. we hear a lot about technology in the accounting space, particularly the technology that we're all familiar with is QuickBooks, either the desktop or online version. And so one way you can use technology is simply decide, do you prefer to work with online or desktop, and structure your options in a way so that it helps incentivize the customer to work with the technology that A, you either think is best for them, or B, you prefer. So for example, I would think that you really want to get your customers to move to the cloud. You want them in the online version because it makes accessing their books easier. You don't have to worry about, do they have the right version? Do they have to install patches? What about conflicts with operating systems? All that kind of thing. So you could, for example, charge less to work with the online version and charge more to work with the desktop version. Another way is consider what add-ons that you could use with QuickBooks, things like Receipt Bank and other types of apps that can extend the QuickBooks ecosystem for them, particularly if you're number one, showing them how to use that, taking care of the integration, and also helping cover those charges as part of whatever price you're charging the customer. The fourth T is terms, and payment terms specifically is what we're talking about now. Probably the most common example of payment terms that I see in accounting and bookkeeping is you agree to, say, a yearly figure. Let's just use, $6,000 as an easy number. And so the customer is going to divide that by 12 and pay you $500, ideally at the beginning of every month, using some type of auto draft or credit card. That's one way. Another way you can use payment terms is say, well, we will allow you to pay that monthly, but if you pay us quarterly in advance, we'll actually offer you a slightly lower price. So maybe you offer them a price of $5,500 if they will pay it quarterly in advance. You can also consider forms of payment as part of this. Do you accept check, credit card, bank draft, etc.? You can get really creative with payment terms, particularly when you're offering bundles and packages of services that it's hard for customers to get easily elsewhere. The fifth T is time frame. This is timing. The company that I think about with timing is FedEx. FedEx taught us that they're the company to go to when you absolutely positively have to get it there overnight. If you've ever shipped anything with FedEx, you know that they will charge you an arm or a leg to get it there the next day. In fact, they were smart enough to realize they could create two options for next day. They'll get it to your recipient by 8 a.m. the next day, or just sometime in the afternoon. Here is the thing that you need to realize is a lot of times the packages that get there at 8 a.m. are on the same truck as the packages that get there in the afternoon. FedEx is actually incurring increased costs to go back out there and deliver the packages later. But what they've realized is the perceived value to their customers for the 8 a.m. delivery, that price more than covers that. So that's one example of time frame. Another time frame would be a customer comes to you on March 15th and wants you to get their tax return ready by April 15th. And they own two businesses and they have some investments and this, that, and the other. And so it's not a simple type of, 1040 easy situation. Training or education. Now, I actually prefer the word education. The best way to explain that is if you're a parent and you have kids, would you rather have your kids have sex training or sex education? I think we would all agree we want them to have education. There are several ways that you can offer education to customers. You can do it through written material, through videos, such as what Hector has on his YouTube channel. You can offer it through live online training or recorded online webinars or live training. You can offer it in multiple sessions. You can offer it at different levels. There's all kinds of ways you can package education and training, but it's really something to think about, particularly if you can offer training in a way that helps the customer do something that there's really no other way for them to do it. The last T that I'll talk about, I use the word travel, but I think of it broader as expenses. And I actually think the most guilty profession with this would be lawyers, because, and it's not so much now, but in the past, They would charge you for every photocopy they had to make, every fax they had to send. They would bill you for mileage. I mean, literally, you felt like if they put 2 packets of sugar in their coffee, they were charging you for each one. We call it nickel and diming. You don't want to nickel and dime your customers. Why? Because it cheapens the perception of what they're getting. It actually reduces the perceived value. So let me give you a more current example. Let's say that you have to incur $1,500 in travel expenses to go see a customer each quarter. Okay, that's one quarterly visit. Well, if you're going to charge $4,000 for your services, and you know that with 2 weeks notice, travel is going to be about 1,500, well, your price per quarter is not 4,000 plus expenses. It is $5,500, including including all expenses. And if you use that language in a proposal, it actually makes you look more professional, that this price is inclusive of all expenses. So those are the 7 T's. So let's take a look at an example that Hector gave me. Now, this is actually one that he wrote. And so let's just kind of go through this and let's see if we can kind of pick out some of these different bullet points. Which of the T's are they playing off of? So let's take a look at the basic service. And by the way, you'll notice he's named these basic, premium, and deluxe. Obviously, deluxe in this case is the most expensive, whereas the basic is the least expensive. By the way, when you offer 3 options like this, it's helpful to present it the way Hector's done in 3 columns, because it makes it easier for the customers to compare. It makes it easy to see what's excluded. And by the way, as human beings, we want what we can't have. And so this actually, when customers can see it visually like this, it helps lead them toward one of the higher options. Statistically, they'll typically pick the middle option. Well, let's start with the basics. So reports delivered by email. Okay, that's one use of technology. It's also a level of access. All accounting and tax questions via email response within 5 business days. Compare that to the premium, where it says all accounting tax questions via email response within 2 business days. There's a timing element, so there's the timing. Compare that with the deluxe option, all questions via email or phone, same business day. You'll also notice that some things are consistent. So for example, between basic and premium, they both have a 1-hour on-site call to discuss the numbers, but on the deluxe, it's a 1-hour mid-month call to discuss progress. So there's a difference. There's also a difference in timing between basic and premium regarding delivery. By the 15th of the month for basic, by the 10th of the month for premium, by the 7th of the month for the deluxe. The deluxe even includes something that's not in the other 2, which is the 1-hour on-site call to discuss numbers, budget performance, and forecast. In other words, Hector has said there are certain things that I will discuss with a customer on the deluxe option that we won't be able to talk about on premium or basic because it's outside scope. So he's hit on at least 3 or 4 different T's here, and there could be more. So this is a realistic example of how you can use options. And by the way, another one that's implied here, these numbers, the 310, the 525, the 840 are paid monthly. So he set this up so that he's going to get 12 equal payments. So he's using terms, and I know Hector, he's going to make sure that's on some type of auto draft or credit card that's done in advance at the beginning of the month. None of this, the customer hasn't paid me and I've already done the work situation. So there's an example of how those 7 T's, at least 5 of them, apply in this particular situation.
And you mind if I comment on that, Kirk, real quick?
Please.
Yeah. So this particular example, and this is why I sent it to you because I wanted your opinion on it. When I sat down with the customer, the core service, what they wanted in terms of, the financial statements and the delivery of the whole work was very, very, very clear. Like we understood exactly what my role was and what I was going to do. But I almost walked out of this deal because he told me, when I hire an accountant, no matter what, I need a response same day. By the way, this is a very light job. I mean, this is something that takes a couple hours for us to do. It was pretty standard, not that many transactions. But he told me he needed a response the same day, that was a non-negotiable to do responses the same day. So when I was speaking to him at the beginning, I thought, okay, this is going to be a couple $100 job, very simple, very routine. But when he said that, what I did is I framed it where I am going to deliver that option that he wants. And for me, it's not ideal to answer the same day. So I did that and put that on the highest option, because I wanted to frame the customer to pay the premium, or the deluxe in this case, to pay the extra for wanting that. And then the customer convince himself, you know what, I don't really need same day. 2 days is good enough for me. And they ended up going with the premium option, which is what I wanted in the first place. So I used their own needs and value, not I want to say against them, but I used it to frame, that level of service they want has to cost more. And at the end, when they realized that maybe they don't need that, that was just out of spite or whatever was going to the guy's mind, which, by the way, I never taken a client on same day response time. I typically put it high enough that if they want it, they pick it. And many a times when they see the difference and it's pretty much the same service, they won't pick the highest one if 2-day response time seems almost as good as 1-day response time. So that's why I wanted to send it to you, because this wasn't a scope issue. This was a response time issue.
Right. This is called an access level agreement or access service agreement. You may have heard those terms before from some of my colleagues at VeraSage. And so definitely agree with your comments that, number one, for the best level of access to you, the customer should be paying a premium, and also use your options and pricing to help steer the customer where you want them to go. And if they are going to choose something that is something you really don't want to provide, them paying a premium price for it is going to help compensate you for doing something that's generally not your preference. Let's take a look at another example. Now, I'm going to use an example that I get this question a lot when I speak to accountants and bookkeepers is, what about QuickBooks conversion or cleanup? And I'm going to contrast this or compare it with something I've done in my software business. Now, I have a custom software development company. And with custom software, the quality that you get out of the project really boils down to the testing that's done at the end. And that's very similar to with QuickBooks conversion or cleanup. You have to ask your customer to go in and look at the books afterwards. You have to make sure the chart of accounts is correct. They know how to put in the entries and so forth. Same thing with software projects. And so we were dealing with this conundrum of, okay, customers want high quality software, but yet they don't want to do the testing. How do we turn that into some type of incentive? How do we put that in a situation where if they want higher quality, they're willing to pay more? What we came up with was something we called user assurance. And it was basically an increased level of quality quality assurance on our part, where we actually did more of the testing for them. We actually hired somebody else to go through an additional level of testing that normally we don't do. The alternative was the customer could do that testing themselves. And the way we framed it was exactly how Hector described on the previous options. The customer paid significantly more for us to hire somebody else to do the testing. One of the things we learned from this, we really thought, okay, we offer that 6 times, one customer out of 6 will select that. We found it was more like 5 out of 6 picked it. They were so concerned about quality, they were willing to pay premium for it. And for a while, we were selling our highest option 5 out of every 6 times, and we had to come up with another option. But we were getting paid well for it.